and elaborate on anything, I'm more than happy to do that.
Yeah.
Okay.
Okay, well, welcome everybody. So this is our Friday night MCFAM Seminar, and it's a pleasure for us to have Liban Mohammed here, who is a math PhD student at the University of Wisconsin-Madison, and I think as he just mentioned earlier, he's studying solutions of the Schrodinger equation on discrete spaces, which I believe is related to physics.
Mm-hmm.
Actually, I don't just believe that. I'm pretty confident that is in fact related to physics. And then Liban, and I had the pleasure of getting to know Liban earlier this summer, or this last summer. Liban participated in an IMA boot camp called Math to Industry Boot Camp, which was an opportunity for PhD students in mathematics to learn a little about what they need to know if they want to go out and work in industry as opposed to work in academia. And as a recent employee of Securian Financial, I managed to get Securian to sponsor one of the projects, which Liban was a participant in. And I consequently asked him if he would present on the work that his team did. And so it wasn't just Liban, there was an entire team of people. But I thought I would ask him to come and present on the work that they did. So without any further conversation around that, I'm just gonna let him take it away. And again, since we have a relatively small group, some of you had just arrived, you should feel free to interrupt and ask questions. And off we go.
Yeah, thanks, Gary. So as Gary said, my research outside of, this particular project has little to do with financial mathematics. And before the summer, I, was a complete novice. I'm still not an expert, but I did have a really good time working with Gary and with Marshall Lagani at Securian and my other teammates. And so I'm very happy to be able to share the work that we did then. So let me go ahead and share this PowerPoint. All right, so what we're going to be talking about today is efficient risk sensitivity estimation for a particular type of insurance contract. And so I do want to highlight we have, my other 6 teammates, Gabby, Odeyemi, Priya, Chloe, Radmir, and Jaden, and then Gary, of course, along with Marshall Lagani at Securian, were very helpful in guiding us through that this research project. So first, I'll talk about some basics things, just like the outline of the objects that we're talking about, these sorts of contracts, some sort of issues that come up, and what the challenges that we have to deal with as underwriters. Then I'll talk about our plan, and then the results that we derived, and then talk about some limitations and open it up to questions. So just so you know, a variable annuity is it's a contract that you can think of as being very similar to a 401k. So there's an account that has a certain amount of value in it that some policyholder has. And the insurance company commits to pay out some stream of payments to the policyholder. And then like a 401k, the value in that account depends on some underlying portfolio. So as I emphasize here, this type of policy allows the wealth to grow with the market, just like a 401k, but unfortunately it also allows that wealth to shrink. So in order to mitigate that risk that comes with the potential shrinkage of these underlying securities, oftentimes insurance companies will provide riders as well. So these can be things like guaranteed minimum account benefits, withdrawal benefits, income benefits, and there are I don't know how many different permutations on these basic rider contracts. Collectively, they're referred to as GMXBs. And we'll be focusing in particular, just so that we have a concrete example to work with, on the guaranteed minimum account benefit. And so what that says is that at the end of some period, at the end of some amount of time after the onset of the contract, the account value will be the maximum of the account value itself, as computed by this usual sort of 401k-like procedure, and then some predetermined benefit base. And the benefit base might be the amount of money that's in the account at the initial, at the beginning of the contract, or it also might be the amount of money that's in the account after, maybe like subject to some sort of exponential growth. And so in particular, the way that I want you to think of this is being like a fancy put option. And so So a put, you may know, is a type of options contract where essentially you buy the option to sell some, some stocks or something in some quantity at some later date. And so essentially it's a bet that the value of that thing will go down, because if you're able to buy it at some, or I'm sorry, whoa, I totally messed it up. It's the option to sell it. So the call is buying, and then the put is selling. And so if you can sell something at a higher price, that's, at a price that's actually higher than the market rate, then you can of course just buy it at the market rate and profit from that sort of arbitrage. So it's a put option because for the policyholder, what this allows them to do is to recover the losses that they would have observed, if they were forced to take the account value as it diminished in response to some declining underlying equity price. On the other hand, it's not just a put option, it's a sort of a fancy put option because the pricing is a little bit different, and that makes it somewhat more difficult to sort of analyze, and we'll come to that in a little bit. So here's just a sort of like a pictorial representation of what these things look like. In this horizontal axis, we've got the time in the contract. In this vertical axis, we have this account value. And as you can see, the account value sort of fluctuates, ostensibly in response to the fluctuations of some underlying stock. And so this red region represents the moment-to-moment liability that the insurance company has. From writing this rider charge, this GMAB guarantee. So if the contract ends at the end of this graph at like 1,200 something, then the liability that is that's sort of owed by the insurance company will be whatever this is here. It's something like 10-ish. Okay, we don't even have units, so this is maybe not the clearest of graphs, but it's something like 10-ish. In some ways, the insurance company is actually very lucky that the contract didn't expire at 1,000, because they would have been liable for more. On the other hand, had this contract expired at around 700 instead, the account value would be above the basic benefit level. This does not mean that the insurance company receives money, of course, from that. From the policyholder. It just means that the insurance company doesn't have to pay anything out, which is about as good as you can hope for in this sort of case. So I want to emphasize that it's not the case that we're sort of paying out at each sort of time step in which there's red, but rather that if the contract were to end at any point when we're in the red, then the insurance company is responsible for paying out. And so just so that you have something that's a little bit more, say, precise to hold on to, because I think that can sometimes help. Here's a formula that you can look at to sort of understand how these account values change. So we look at, T represents the time, S represents the underlying equity fund, A is the account value, and then delta T here, this one corresponds to the period with which these charges are assessed. So at every time step, some amount of money is withdrawn from the account to fund its administration, and so that happens with a period of delta T. If the annualized expense charge is EC, then the daily expense charge, or maybe this like periodly expense charge, is going to be EC times times this delta T divided by whatever the unit is, in this case years. And so what actually happens? Maybe I can rewrite a portion of this equation here. So we're going to say that A of T plus delta T is equal to A of T, times this proportionate increase in the equity. So this is going to be S of T plus delta T divided by S of T. So with just this much, of course, A is simply changing in proportion to the changes in this equity fund. However, we do have this very small charge that's assessed every time a delta T passes that's going to draw it down. And it's important to understand that DEC here is actually being multiplied by A of T. And so what that means is that the expense charges are typically larger for larger accounts. At the end of this time period, the account value is set to be the maximum of, if the basic benefit doesn't increase, just the account value at the beginning of this time period, or the account value at the end. So this thing here corresponds to, in this image, taking the maximum of the account value and then this gradually increasing line. So from the insurance company's perspective now, it's all well and good that you're providing this service, but underwriting these GMABs, these GMXBs, exposes them to a certain amount of risk. And this risk takes a couple different forms. If you were here before we started talking, you heard Gary mention this sort of like insurance risk. So of course, if you can expect investments to grow at a relatively fast rate because of higher returns sort of across the market, then the insurance company can actually benefit from from having the money for the interim period between the instantiation of the account and the eventual payout. Alternatively, as we saw earlier, if this underlying equity performs poorly, then of course the account also performs poorly, and there's a risk there. It may be worth pointing out that in this case where the underlying equity performs poorly, not only does the GMAB itself require more funding to meet that benefit base, but also, of course, the expense charges are smaller, and so there's a sort of a double whammy there. But something that I didn't explicitly write down here, just to clarify what I mean by a lot of risk, is actually that the sort of risk involved in ensuring this, underwriting this sort of contract, it's actually, it's a little bit more difficult to mitigate than if you're doing something like, a basic life insurance policy, where you can simply rely on the law of large numbers, where if your statistics about how people tend to expire are good enough, then you can hit some mean value or slightly higher than a mean value in charges very effectively, and simply by accruing a lot of people, provide a service to everybody without taking on too much risk. However, of course, you should know that that stock price changes can be very swingy. They can be somewhat fat-tailed, and so the result is that you need to do something other than simply taking on a lot of these, policyholders. And so the way that we do that is by hedging. So a hedge, as we say here, is an investment position that's intended to offset some potential loss. These originated actually in agricultural futures, or rather, so futures trading originated with agricultural commodities. So you might be some wheat farmer who's exposed to some like volatile price changes in the price of wheat upon the time of harvest, but of course, it's a perishable good, and so it needs to be sold at some specific time. In this sort of setting, the farmer may want to forego some upside if, in the case where the price of wheat is, higher than expected, in order to protect against the downside, and lock in a price by selling some forward contracts that say, I'll deliver this amount of wheat to you, when it's harvested, for a predetermined price. So of course, we're not talking about wheat and agricultural commodities in this particular case. We're talking about some other sorts of things. And so typically what happens is that Securian Financial, for example, will trade some options and futures and swaps in order to protect against these risks. So again, to be formal about it, let's refer to this underlying equity again by S, and by R, the risk-free interest rate. And then just let's also refer to the volatility of this underlying equity by sigma. And so then we refer to the derivatives of the value of this contract by the following letters. So delta refers to dv by ds, that's the partial derivative of the value of the contract with respect to the change in the underlying equity. And rho is the corresponding derivative with respect to the changes in this underlying interest rate. So just to give you some sort of concrete idea, here's an example that Marshall gave us back when we were initially sort of orienting to this problem. Let's suppose, and these are numbers that he claims actually make sense for a company like Securian. So let's say that we have $125 billion in delta exposure, and we might have some hedge assets valued at $1.2 billion. And note that that's like a 5% difference. And then let's suppose that markets fall by 1%, which leads to a loss of 125 million from this liability that we hold, a gain of 12 million, and then a difference which results in a net loss of $500,000. So there are a few things to note about this. The first one is that $12.5 million is a lot of money, and you don't want to lose that amount in a day. And that's what would happen if without having these sort of hedge assets that have different sort of price sensitivities. And then by getting to within this particular 5% threshold, we observe this net loss of $500,000, which is substantially more palatable. I don't think that I want to lose that in a day, but it is somewhat more palatable. Of course, so maybe just to give you some idea of how this performs, relative to some benchmark. Something that Gary told us was that, just for intuition, we might try to target like a 1% hedge error, at least in the, in the estimation of these risk sensitivities. Above 1%, and it seems like, if you're looking at this 5%, sort of tolerance level for, pairing your hedge assets to your liabilities, then it's, you're still sort of exposed to quite a lot of volatility. But below that, then what happens actually is that you run into some operational constraints. And so you're running up against some limit where it's difficult to actually hit the target hedge asset value when you're trading on the floor on a day-to-day basis. So just to sort of give you some idea of what people in the, in the field actually shoot for, it's something like a 1% tolerance. Now, and here's an illustration of what this actually means, in terms of this sort of account value picture that we were talking about earlier. So let's say that we're right here, and it's day 500, and the price of this underlying equity increases by some small amount. If that's the case, then this future behavior, for the account, where it's, going sort of up and then down, it follows the same rough pattern, but it's been shifted by some small amount upwards. And as you can see, what happens at the end of the contract, is that this, the payout for the GMAB actually decreases a little bit in response to, on day 500, the price in this sort of equity going up a little bit. And so this is an illustration of this delta. If you're here, in time, and the price of this underlying equity increases, then you expect to pay a little bit less at the end of the day. Or rather, at the end of the contract. Okay, so remember what I said about these, these GMAB contracts and so on being like fancy puts. Well, unlike, sort of, if we're talking about like a European option that's done, using these sort of Black-Scholes models, it's not possible to, to directly find a formula, or if it is, it can be very difficult to find like some formula that captures the value of the contract. For many of these types of variable annuities. And so instead of using some formula to estimate the value of this thing and then differentiating that, rather what we have to do is we have to estimate these Greeks via some Monte Carlo simulation. So the way that this process works is that we randomly sample future equity behavior and also future policyholder behavior and compute the present value of the contract for that specific trajectory. So that corresponds to, looking at this thing over here, we sample what happens in the future. Right, the blue line after this, this 500 or so, is hypothetical stock movement. But it's one sample, and if we do that enough times, an average, we get an estimate for the expected value. Now, the question is, what exactly do we mean by many times? And here's an example that's taken from a paper by Clayton and Morrison from Moody's in 2016. And it actually may be worth saying, the reason that I included the date there is, or, want to bring that up is because, it does seem like this sort of behavior, this sort of like hedging approach, is changing on a relatively fast basis. And so what's reported in Moody's, 4 years ago may not be the state of the industry at this point in time. My understanding is that the industry has moved towards hedging on a more regular basis. And then also, some people are using substantially more sophisticated techniques to do this estimation. So let's suppose that we have 1,000 runoff scenarios. Those are the scenarios that have to do with the policyholder behavior. And then we've got some number of hedge rebalancing time steps. And then we run a bunch of these valuation scenarios that sort of talk about how this equity, this underlying equity is moving. And if then we want to estimate both the base value and also 2 Greeks, that's 3 times, we end up with 14.4 billion scenarios. That's billion with a B. That's a large number in case you're not familiar with some computational math stuff. And in particular, the main consequence of this is that we're not able to estimate these hedging parameters on the fly. So if you want, you have some assets and you want to hedge them, it takes a certain amount of time in order to actually run the computations necessary to determine what the proper hedge parameters are. So, so I want to be really explicit about this. And so we're going to talk about the actual process that happens. So the market it's very volatile at the beginning of the day, which means that you want to hedge at the end of the previous day. But you can't just, push a button and immediately know what those hedge parameters are going to be, which means that you need to have an estimate for the hedging parameters the night before that. And so typically the process that runs is that you'll run these Monte Carlo simulations overnight, and they'll tell you what the hedging parameters are for a wide variety of these values of S and R, these market states. And then, and so then you'll have to hedge, at the end of the day tomorrow for some market that is different from, from the market that you see when you're actually computing these hedging parameters. And so let me write this really explicitly. Like, you don't know the market you'll be hedging in when you estimate delta and rho. So that is, okay, well, that's not very legible. Maybe I should just say, like, I teach on this tablet too, and sometimes it seems to correct my handwriting and make it more legible, and sometimes it doesn't. And I think that this is definitely a case of the latter. But I think that that's intelligible. You don't know what the market will be, like what the market state will be when you estimate these hedging parameters. So, here again is this picture one last time to say what's going to happen. Here we are on the night of, 500. This is the night before the day, number 500 in the contract. And so we're going to want to hedge at the end of the day 500 for the beginning of the day 501. And so we have to sort of do some simulation and actually estimate what those hedging parameters might be, again, the night before 500 in order to do it on the day 500. And of course, on the day of 500, maybe the value of the equity will jump. Maybe it'll change in some dramatic way, or maybe the Fed will change some interest rates, and your R value will change. So in that case, of course, what happens is that the liability that you're exposed to may also change. And in particular, these delta values and rho values may change. So if we compute delta for, for the picture that we were looking at earlier, we did see some responsiveness for this particular simulated trajectory in order, for a change in the underlying equity, because every little bit that we saw over here of increase in S translated into some small increase in S over here, which again corresponds to a decreased liability. However, if the market does change, if it jumps quite a bit, then it may be the case that for some future trajectory, we won't see any change in the liability of the insurance company at all. And so in that case, the derivative will be zero, at least as far as the value of the GMAP is concerned. Okay, so here's the formal problem statement. This is the way that we came to understand it. So let's say that you have market states omega and contract parameters theta. So theta entirely describes your contract and omega entirely describes your market. For the case of this project, we were just interested in S and R, which are again the value of the underlying security and the risk-free interest rate. The insurance company has some set of contracts, CJ, and each one has a value that depends on the current market state and its own individual contract parameters, the theta J. And what we want to do is we want to understand the trade-off between the error and the computation time and estimates of our Greeks over some region. Now, we don't need this region D to be all of the possible market states because, generally speaking, the market's not going to, it's not going to do literally anything. It's going to stay within some, some relative change. The numbers that we were looking at were something like plus or minus 10% in S and plus or minus 10 basis points in R. However, the question is, how do we optimize this trade-off between error and computation time, given that we don't, at the time that we're estimating these hedging parameters, know what the market state is going to be. So the plan that we have, the plan of attack is essentially to use this sort of meta modeling technique.
Oh, hold on. Could you
sure.
go back to that last slide just for a couple more seconds?
Yeah, happily.
Trying to catch that. Thank you.
Yeah, sure thing. Yeah, was that a screenshot?
No, that's just my computer making shenanigans. I'll be on the computer soon, but I've been roughing it on my phone here.
No worries.
Decided it had to update.
Just as actually, maybe this is something else to share. I think like on these, on these Zoom seminars, I actually kind of like them because you can just screenshot people's talks all the time, which is, super helpful if you want to go back and actually look at something in more detail. But that's it. Are you happy or do you want more time?
Give me one more second.
Yeah, sure thing.
All right, got it. Thank you.
Okay, cool, great. So again, we have this value, and we want to estimate it over some region S and R, and we'll see graphs of that as well. So what the plan is essentially to do the following. We'll consider some collection of points, Sj, Rj, and these are hypothetical market states that we might observe at the end of the day, tomorrow. And we'll do Monte Carlo estimates to find some pretty precise estimates for the risk sensitivities for delta and for rho at those points, Sj, Rj. And then if the market doesn't happen to land precisely on one of those states, Sj, Rj, instead what we'll do is, we'll interpolate between the estimates that we get at those guys to figure out what, roughly the risk sensitivities are at some points S and R. So this is called a meta model because we have a stochastic model that's producing these Monte Carlo estimates, and then we're doing some interpolation on top of that with another model. And this leads us to some questions, right? So the first question is, we have some points Sj, Rj, and which ones should we pick? Like how do we best distribute these, the sort of the Monte Carlo runs through this space of Sj and Rj in order to sort of, really to find the best information. Then the second question is, okay, we're gonna do something at these locations, and what exactly should we estimate? And this is sort of a vague question, but I'll talk about exactly what I mean by that in a little bit, in a few slides. Then the third question is, okay, we have some estimates, and then how are we going to interpolate to get to other values of S and R? So the first thing is this question of choosing S and R. And so what I'm about to do is I'm going to show you a GIF that describes a particular sort of process that we did to estimate, to sort of like get a heuristic based on this. But unfortunately, the GIF came from some early exploration in this topic, and so it's not particularly well labeled, so I have to explain it beforehand. So this picture that you are looking at here, you should think of as being a slice of SR space. So here's the S-axis, and here's the R-axis. And this point in the middle, this 10, 10 according to the axes, is actually just, it's just some point S0, R0 that corresponds to the current market values right now, at the end of day 499. And what I did was, initially we distributed this weight randomly across the space of plus or minus 10% in S and plus or minus 10 basis points in R, where we said, like the color at each one of these points corresponds to a certain amount of number of Monte Carlo simulations run at that point. So if a point is very bright, that means we're doing a lot of Monte Carlo simulations at some point. And if it's dark, that means we're not doing very many Monte Carlo simulations at that point. Across this whole GIF, across this whole region, I think it's something like 10,000 simulations that we ran. And then at every time step, what happens is that we choose 2 points in this domain. Maybe they're this one and this one. And suppose that the current allocation of simulations says that we're doing 250 Monte Carlo simulations at this point and 50 simulations over here. Then at that point in the at that time step where these 2 points are chosen, the program is allowed to shift weight back and forth between these two in order to see what the optimal allocation is. So if you're familiar with a stochastic gradient descent, this is exactly what this is. It looks at this particular direction. That's the shifting of the allocation of weight between these two points, and then sees how the overall estimate, the overall model of delta in this particular case can benefit by shifting weight back and forth between these two. So let me now go to the GIF itself. All right, so okay, so what you'll see is that initial distribution of weight of computation time across the whole region very quickly coalesces to some very few points. And so this is going to loop, and I'll describe it as it does. So eventually what you see is that there are 3 or 4 points, maybe up to 5, that have a bright yellow. And that means that a lot of computation time, a lot of these Monte Carlo simulations are being spent nailing down those points very, very precisely. And then there's also some smattering of sort of computation time across the rest of the field. And that is, as far as I can tell, just noise. But the real takeaway here is that there's a benefit to estimating a few points, getting delta down very, very precisely at a few points, and then interpolating based on those few points to the rest of them. Because if you're able to get, like there's a trade-off when you put computation time across a couple different places, right? If you put a lot of computation time into one point, that means that you can estimate that guy really, really precisely. And of course, law of large numbers, the variance that you observe, or the error that you observe, decreases 1 over the square root of the number of times that you sample from that point. However, if you get that point down really, really precisely, then unfortunately you're not able to get some other point, as precisely. And maybe, because of the way that this function is continuous, you may not be able to estimate as precisely in some other region in this space. So that is intended to justify the takeaway that we. The first of our takeaways, which is that okay, this decided to shrink on me for some reason. Unsure why. Okay, I guess we'll just continue with this shrunken PowerPoint. Okay, so the takeaway that we take from that experiment with the stochastic gradient descent is that it's better to sample few points to a higher precision rather than many points to a low precision. And so now we'll go into the actual methods that we use to interpolate between these points. So the first one is based on a method that was actually in use at Securian, and it was described to us by Gary, called the sort of trading grid method. So the idea is as follows.
So Liban, is there a way you? I know you struggled a little bit. Is there a way you can blow that up? Maybe pinch out or something like that?
Oh, perfect. Yeah, of course. Great. How's that?
Yeah, that's great.
Okay, cool. So, okay, so let's look at this first of our interpolation methods. The way that we're going to do it is, let's say that we're centered currently at some point S0, R0. So this is our point here. What we'll do is we'll sample at this point S0, R0, V rho, the derivative of rho with respect to R, those three things there. And then at some other points, plus or minus 1%, plus or minus 2%, plus or minus 3, 5, and 10, what we'll do is we'll actually just sample V. And so our intent here is to create a spline that connects these estimates for V along the line S comma R0, which is this line here, this vertical line. And so we have a spline, some interpolation spline that connects these points and tells us roughly what the value for V must be at each of those points, along the line. And then we extend this spline to all of S of R space by doing essentially this quadratic extension. So there's some derivative in R, and then also there's some quadratic term. And we don't allow that thing to vary. We just use the estimates for rho and for the derivative of rho respect to R at S0, R0. You can think of this as being like a Taylor expansion in R, just at S0, but then we push this up and down the line, we translate it. And then we differentiate this guy to get our estimates for delta and for rho. Ignore the tilde over delta. That's from a specific sort of technical thing that I think we don't need to get into. Okay, so that's the idea. And we'll use this as our benchmark. And so here's what happens. The first thing that you can see is in these heat maps, maybe let me describe what's happening. The value up here corresponds to the color again. So the more intense the color at some point in SR space, the larger the error. So now it's not computation time, it's not Monte Carlo runs, but rather the error that we observe over some, averaging over some number of repetitions. So the first thing that we see is that the error in delta is highly correlated across lines of equal delta, or of equal S rather. So, so here we find that our error is, essentially constant going horizontally. And that essentially is due to the fact that we're really only collecting the estimates for the spline along this vertical line, S, of changing S. The second thing that we noticed, just as some benchmark, is that we're looking at about a 0.8 error, and so this is actually this is the percent of the value of the quantity that we're estimating. So this error of 0.8 actually means that the mean absolute error is actually up to 80% of the true value of delta. And so, it's clear that in much of the region, even when we're only doing 200 Monte Carlo runs total, we have substantially less than this 80% error. But up to 80% error, just at this sort of line down here at plus 10% S. Then this top error decreases to 0.2 in delta and then 0.12 in delta as we progress through 1.6 thousand Monte Carlo runs and 13,000 Monte Carlo runs. And in rho, these errors are much more tame, but they also don't decrease very much, going from 0.015 to 0.012 and then 0.01. The next thing that I want to say is that this sort of pattern in the errors in rho suggests to me, at least, that that using the same quadratic sort of term for each point to extend this sort of spline in V in either direction in changing R is actually obscuring some, it's sort of obscuring something, and the way that this sort of curvature is changing as we change S. Nevertheless, this is our baseline, and I'll remind you of what these numbers are as we go through them and compare to some other methods. So the next thing that I want to talk about is actually just estimating these derivatives directly. So what you notice is that, if I sort of remind you, we had some points. At one of them, actually a bunch of them, we estimated V. And then at one of them, we estimated rho and also rho sub R. So it turns out that direct estimation of the derivatives can be done like very poorly or very well. And essentially it goes through a technique called cluster sampling. So just, as a like Calc 1 review, I feel like I'm spending a lot of time doing this with my students these days. But, if you want to estimate the derivative at some point x, here's some function f of x, then typically you sample it at 2 points and you draw a secant line and you observe what the slope is. And that's an estimate for your derivative. Now, the problem is that in this case, we're not able to estimate the function directly. We don't have that curve. Instead, what we do is we get some cluster of points that correspond to estimates for V at some point, and we get another cluster at some other place later on. However, if we don't couple these guys, then they can vary quite a lot. And especially if we take these 2 points close together, if we move these 2 points closer in here, corresponding to a smaller h term in that limit, then this slope can be very wildly divergent from the true value. Now, it turns out that there is actually a way to mitigate it. And what ends up happening is that you end up with the same sort of spread, but you end up with slopes that are more correlated. And this actually corresponds, I should have repeated this picture again, but it corresponds to doing this sort of estimate here. So if you run a simulation, remember, so in this Monte Carlo simulations, you sample the future behavior of the stock market, starting at this sort of time here. If you couple these estimates so that you run a single simulation and then bump it a little bit, let's talk about this. I'm going to erase some of this stuff here. So you run a single simulation, that's this blue curve, and then you also bump it and run the same simulation of the future world, then you're able to couple these, couple these runs in a way that allows you to eliminate a lot of the variance, right? Because if you don't do this coupling, then the risk that you run is that, you'll run 2 of these guys, they'll have the same, beginning, and then one of them will behave in some, I guess it doesn't go below 0. One of them will behave in some way, the other one will behave in the other way. And despite the fact that you're, they correspond to some small changes locally in S, they may have very, very different behavior at the end of the day in terms of this GMAB liability. So the first thing is that simply by clustering these things, we can actually reduce the amount of computation time that goes into estimating these derivatives. And depending on exactly what the curvature is like, and what sort of tolerance for error you're looking at, I mean, this difference, this can make a humongous difference in terms of the amount of time it takes to converge. We're talking about something like on the order of 100,000 times faster using these sort of clustered estimates. Now, you can actually use these clusters to estimate. Maybe let me get rid of a few of these guys here. So you can use these clusters to estimate higher order derivatives as well. So if we're looking now at SR space, and these 2 points here are the points that form the base for the secant line that we draw to estimate the change in S, then some optimal configuration actually of sort of samples lets you estimate the partial derivative with respect to S and the partial derivative with respect to R simply by taking 3 points. So this difference here allows you to estimate delta, and this distance here allows you to estimate rho. Now, you can actually, if you're willing to sort of accept a certain amount of shifting in S and R, you can get all the second order partials by expanding the cluster out to a triangle that's bigger. So now you have 2 estimates for rho, and in conjunction, they give you an estimate for the change in rho. So that's the second derivative with respect to R. Same thing, 2 estimates for delta gives you an estimate for the change in delta, which is that second derivative with respect to S. And then having this box in here allows you to estimate how delta changes with respect to changes in R and how rho changes with respect to S, which is to say that's your mixed partial. It turns out that this triangular configuration is actually optimal in terms of the number of points that it takes to sample arbitrarily high derivatives. But maybe let me just leave it at there instead of going more into this sort of question of geometry. Nevertheless, the question is, what happens when we just sample the derivative instead of sampling V and derivative? So again, let me remind you, before what we were doing is we had V estimates at some points, and then V as well as rho and rho sub R at some point S comma S0 R0. So this derivative spline, what we'll do is we'll get delta rho and delta sub R at every point now. And also rho sub R. So on the face of it, it actually looks like we're collecting more data, and that's in some sense because we are. Delta rho delta delta sub R, and then rho sub R. And then what we'll do is we'll make 2 splines. One spline P, which does essentially the same thing that we did before with V along that line of constant R0, but now instead we'll do it just for delta directly using these cluster samples. The other thing that we'll do is create the second spline R that just estimates rho directly from the cluster samples along this line of changing S and fixed R naught. And then we also do the same thing again for delta sub R and rho sub R. And then we just put these together in the following way. P, which is our estimate for delta, becomes P of S comma R naught, which is the delta along this line, or the estimate that we get from it using this cubic interpolation, plus a linear term now that corresponds to Q, which was our delta sub R. So we have some spline that tells us what delta is roughly along this line here, and then we extend it out linearly in any direction, which corresponds, of course, to having a quadratic extension in any direction, as we had with our previous trading grid method. The difference, of course, is that by taking, by having a spline in S that describes the changing derivative with respect to R, we're able to let the slopes of these lines vary instead of having them fixed across the whole thing. And so how well does this perform? Pretty well. So let me write out the numbers that we had beforehand for our maxima before. So before these were 0.8, 0.2, and 0.12. So performance is substantially better, especially at low Monte Carlo computation for delta. Beforehand for rho, we had this 0.015, and then 0.012 and 0.01. And unfortunately, what we see is that rho is actually not substantially better. I mean, granted, we were starting at like a 1, 2, 3% error just to begin with, even with 200 Monte Carlo runs. But you see that the error it's a little bit less, it's less correlated. It doesn't have that same sort of distribution to it, but it's not substantially better. However, I think that on a whole, especially given these vast improvements at delta, especially when we're looking at the smaller numbers of smaller amount of computation time, I think that this is generally a success. So our second takeaway is estimate the right thing, do the derivatives using these cluster samples, rather than estimating d, v and then differentiating, to do this calculus. Okay. So the next thing that next iteration that we'll talk about, which illustrates the next sort of takeaway, is that we want to, I think that doing strict cubic interpolation is not a common procedure in in these applications when you're sort of measuring error, but I think it's worth actually illustrating explicitly the benefit that you get by doing this. So this thing is actually, it's the same thing as before with this derivative spline that we talked about before. However, the difference is that instead of interpolating with a cubic spline, we use the normal univariate smoothing spline to interpolate. So essentially, in case you're unfamiliar with the difference, if you have some curve that looks like this, or maybe some sample of points, a cubic spline will, be very insistently exactly hit each of the points along that, along that line. However, if you allow for some error, then it becomes less sensitive to these variations, and and doesn't necessarily insist on like overshooting in order to precisely hit each of these points. So with that sort of heuristic description of the difference, let's now turn to these improvements. And what we find is, again, these numbers for delta are substantially better than they were even one step ago. So with the derivative spline, using the strict interpolation, we were looking at 0.15, 0.12 here, and then 0.1. So immediately what we see is that plateau that we hit in terms of improving delta is actually ameliorated immediately by accounting for the error. Unfortunately, we don't see much improvement in terms of rho. This number is actually higher, but that's just because there were some fluke errors that came from a particularly bad reading for the derivative at some specific point. So the takeaway that we get from this one is that we want to choose a method that's insensitive to noise. We want to have some way of accounting for the fact that the measurements that we're reading are noisy. And then finally, we'll talk about one that was my I liked it a lot. I mean, it was kind of my favorite. It's a Gaussian process regression. Technically, maybe it should actually be referred to as a Kriging regression, or regression Kriging. And just to give you a rough idea, so essentially the way that this thing worked is, I should open up a new bit and show you some notes. So essentially what happens is that you've got your S and R space here. And you'll sample some points. In this case, what we did was we sampled 4 points. And then we did a simple, just a simple linear regression on these 4 points. So that's just writing, V, hat is equal to some beta naught plus beta 1 S plus beta 2 S R. So it really is a very straightforward. So this is the first step. And then the second step is that you'll do an actual Gaussian process regression. On the residuals that come from, that come from this particular linear interpolation. And the reason for doing this, this particular, this pre-processing step with the linear regression is that the Gaussian process regression typically assumes a mean 0. And so this allows us to not have any drift in that process. And just to give you an idea of what exactly this thing is, if you're familiar with the Brownian motion, then you know that it's some sort of like a random walk where maybe this is time and this is some x value. Now, if you actually have some measurements from a random walk in practice, let's say that they correspond to the previous one, then the question is, what is the likely path that connected these particular points? And so it turns out that you're able to essentially to estimate the expected path that it took, not in terms of what is likely, because of course Brownian motion isn't smooth in general, but these these sort of means from specific points are. But the nice thing about it is that it's an interpolation method that works very well in higher dimensions, where doing splines in higher dimensions is often somewhat tricky. So just say that to give you some heuristic of how that goes on, and to show you how this worked compared to our our previous best method, which was this sort of smoothed out spline, our best ones, our best performance was about, about 0.1 here. So that's roughly the same, 0.03 here and 0.012 here. So delta is actually very, very similar. However, in rho, we see some pretty big improvements. So the previous numbers were 1, 2, and then here 0.02. So we went, here with admittedly a lot of runs, this 13,000, from from a mean absolute error of 2%, the true value, to a mean absolute error of error of 0.3%. And then similarly, we actually find that we're within our 1% threshold for the mean absolute error at 1,600 runs, which is good. And then finally, the last thing that we notice is that these errors are much less, they're not correlated with this sort of like, with these constant S lines. So it turns out that beyond these takeaways, the improvements are pretty minor. And so in order to demonstrate that, let me show you this graph here, which is a graph of the mean absolute error over some number of runs for a number of different amounts of computation, like for a number of different amounts of total computation that was spread out over Monte Carlo simulations. So the trading grid, the one that we started with, is here. In this top line, as you can see, it starts out quite bad with, when you're only doing like 100 runs, you don't expect to be very good, but still with a very large mean absolute error. And then everything else clusters down at the bottom. Zooming in, however, we find that this derivative spline that didn't account for the error in the estimate to be worse than the other three, which cluster, honestly, roughly as well. I didn't talk about this quadratic interpolation, but it's very simple. You just fit a polynomial to a few points. And then we have our smoothing spline and our regression quigging down at the bottom here. Okay, so just some notes about limitations of this stuff and how future work might be different. The first two notes are just about the model that we were working with. Really, it was a toy model. Some contracts, so the contracts that we were looking at actually do seem to be smooth in S and R, at least over the domains that we're looking at. However, for some types of contracts that have cutoffs for particular types of benefits, once some market parameters change in a certain way, those actually aren't smooth in S and R, and so doing this sort of global interpolation may not be very successful. The other thing is that we use a very tame model for this equity movement, and so in this case, what we were doing is we were using these log normal increments for these stocks, and the issue there is that it may be the case, it's exactly how these changes in the equity, in these sort of like underlying equity prices and the interest rates move. These are like a source of some study, and typically it's a little bit more complicated. And also, as I mentioned earlier, it can be somewhat more fat-tailed. So we used a relatively tame model for the equity movement, which means that a lot of the numbers that you see will probably just get worse if a more realistic model, maybe something like a Merton jump plus diffusion model for equity movement is used instead. Another thing, and this is more of like a not extension to the real world, but just note for how we can extend the stuff that was done here. The work with the sampling choice is not definitive, right? So we used a pretty low computation power machine to do a stochastic gradient descent on very low dimension slices of the sort of like allocation of Monte Carlo computation time. And also the method that we used for interpolating was not one of our best. It was done earlier on. So it may be the case that further work with the sampling choices is warranted in order to determine where best to place those 4 points. We did some experimentation, some heuristic stuff, but it wasn't, it wasn't like very, we didn't necessarily thoroughly explore, this full configuration space of sampling choices. And then it's also possible, of course, that other regression approaches would be more fruitful if we had more time and more data. So one thing that we did attempt, but that I didn't have the time to fit into this talk, and our results were, I think, too preliminary for me to want to talk about in detail, is that there are some people who are approaching this question with a neural network. So if you remember our notation from earlier, we were looking at regression in omega cross theta, where this was the space of markets, and theta was our space of contracts. So one member of our team spent some time looking at regressions strictly within the space of contracts, which can save in computation time when you have a large and diverse portfolio. So if you're able to understand these contract spaces and you can sample from them more efficiently, then you can save some computation time then. Another one of our members actually looked at doing a neural network approach, which would be, instead of just doing a regression in the market space, actually doing, we would do regression on this whole space itself. So if you can imagine, like the function that describes the true value of these various contracts that the insurance company is underwriting depends in a very complicated way on the interaction between the markets and the contract parameters. And so there's some hope that a neural network would be able to just like learn the whole thing given enough data. Unfortunately, we weren't able to generate enough data, and we didn't have enough time to explore that as thoroughly as you might hope. However, there is some indication that people have had some success with this out in the field, and so I think it's good just that you know that that's out there and that that's a modern technique.
One question.
Yeah,
what
sure.
type of neural network you guys tried? Just the regular feed forward or RNN?
Yeah, exactly. So we did a regular feed forward.
Okay.
It was, again, like we had only a few days, I think, at the point where we had enough data to even attempt it. And I think that, like that's an area of work that, where there's like a lot more stuff to be tapped. And actually, if you're interested in this question, talk to Gary, because there's a couple of references that he can send you. Or, if you want, you can just reach out to me and I'll be happy to send you a couple papers on this stuff as well.
Thank you.
Yeah, sure. So let me just conclude with a summary. So remember, of course, like estimating these risk sensitivities is a challenge. It's a challenge because you have to estimate some parameters very precisely. They require a lot of computation time, and you don't even know what the market is going to be like when when these things are going to be relevant. So the approach that I described in this talk is to build a meta model by interpolating between some estimates that come from a stochastic model. However, if we want to actually bridge this to real world applications like is done in practice, there's more work to be done, and there are some open questions. So at this point, let me close and I'll open up questions to the floor again.
So I have a question if nobody has one.
Yeah, sure.
So I guess this is more not so much of a yes or no question and not really so much of a math question, but as you observe, as I observe that, there's a number of different types of techniques that you pull into play here. And would you describe, so like maybe put it this way. When you came into this topic, of the number of techniques you brought to bear, how many of them were how many of those did you have to kind of learn on the fly quickly versus how many did you already have expertise in?
Oh, sure. I mean, like, let's see. So several of them are essentially just like splines and Taylor approximations. So those I was comfortable with. The regression, like the Gaussian process regression, was completely new to me. And I think that's, to be totally honest, if we want to be honest about mathematicians and our fancy toys, that's part of why I like it so much, is just that it was, it was like a cool new thing. Neural networks, I kind of knew what they were as a buzzword, but I hadn't really done much work with them. But in general, yeah, I mean, like we went through a bunch of stuff. Turns out that if you have like sklearn on Python, then you can just blitz through feeding models different pieces of data, on a very, very rapid basis. I think we tried something like, like the better part of a dozen over the course of a day, as a group of three, and these were the ones that we landed on.
Thank you. So, and in some sense, from my perspective, that was a little bit of a loaded question, but I think the idea was that, if you want to have a job as an applied mathematician, or as you are, the people here are ambitioning to be financial quants, you shouldn't take the approach of, the proverbial, the man with a hammer who sees every problem as a nail. As mathematicians, you will have a number of techniques in your toolbox. There will be techniques that you're not as familiar with. Don't only use the techniques that are in your toolbox, however. Be prepared to try to use whatever technique will work for the problem. of the day. That would be my messaging there. And I think what Liban actually showed here was that actually bears out.
Yeah, totally. Yeah. I mean, if I can elaborate a little bit, I think like the thing that surprised me most about this particular case is that so many options worked essentially as well as each other. And that it seemed like there really was, some maybe theoretical limit that we were hitting, that we were sort of like coming down and approaching just by like throwing, even the sort of like smooth derivative spline that we talked about came very, very close to hitting that limit, especially for the lower amount of computation time. So I think that was something that I didn't want to hear because I wanted to like, throw something fancy at it, but definitely be just open to whatever the problem tells you, and then put a bow on it and move on to the next problem because there's more money to save.
Yeah, well saved. I mean, and that's another thing too, is sometimes the coolest hammer isn't the best tool. Sometimes the hammer is the best tool, right? Just the very simple one that you've known since 8th grade algebra.
Right.
So.
Yeah, totally. Anybody else have any questions? Maybe I can stop sharing.
So I just want to, I'll finish the talk up here just by thanking Liban once again. That was really well done, and we certainly appreciate you coming out on a Friday night.
Of course,
and I certainly enjoyed seeing you again. For those of you that don't know, Liban just told me he just got a job, so he'll be starting a new job in January. Is that correct?
Yeah, that's right.
Yeah. So that's all very exciting. So thank you.
I guess one quick question.
Yeah, sure.
Very formal question. Do you ever feel like you're telling the future with this kind of math then? Because to me, that's kind of what it seems to be.
Oh, I don't know. I mean, I don't think so. Like, well, so let's see here. I mean, actually, maybe Gary, let me ask you, how do you feel about Nassim Taleb?
So Nassim Taleb is worth reading. I think he wrote 3 books, maybe there's 4 now.
I think there's 4. Yeah.
I think that the joke is he wrote 1 book and then managed to write the same book again 3 more times.
Totally.
Yeah. But I think Nassim Taleb brings a message to the world that the world needs to hear. But he also needs to be taken in doses that are palatable. He's a character. He's if you're not familiar with who Nassim Taleb is, you should become familiar with Nassim Taleb. But don't go overboard, when he starts talking about how stupid financial quants are and stuff like that.
He's definitely, collected his share of acolytes who just sort of like rave about black swans and so on. Anyway, so the reason that I brought him up is because he made a point in, I think, his Black Swan book that I thought was pretty interesting, which is that, he went to some like risk management conference and was really surprised and actually blown away by the talk of like the owner of a casino. Because when you think about like the sorts of challenges that a casino owner has to deal with, largely, like as far as the law of large numbers is concerned, they have the game made, right? You just bring a lot of people in, have them bet. And sure, like in some sense, on average, you're telling the future. But of course, you don't know who's going to win big and who's going to sort of spend all their money. But you just sort of like just bet on things coming out on average, in a way that's favorable to you. But instead of that being the main message of this guy's talk, apparently he talked about like exposure to much bigger risks. And so the big risks are that you have a whale, so somebody who's flown in from typically like another country just to gamble and who will swing really, really large amounts of money around. And so the amount of risk that you're exposed to when somebody's putting in huge amounts of money on each bet is that, they win, right? They're unlikely to win, but if they do, then, you can sort of be out of the game. But also, and this is actually the thing that was most striking, was that the biggest loss that they suffered actually came from essentially from theft. So one of the employees, had either had access to the systems or just took a bunch of cash out. I don't remember the details very well. But when it comes to risk management, there is the stuff that you predict with the formal models, and then there's everything else. And so sure, there's telling the future maybe in some average sense with some assumptions, but That's no guarantee that the future will come out in any particular way. And you also have to recognize that the math that you're doing only covers a certain amount of the world.
Yeah, thank you. That's actually well put, and I guess it's appropriate that you being at UW-Madison that you would essentially paraphrase that all models are wrong and some are useful. So
what is it about my institution that says that I should feel that way?
Because the person for whom that is attributed to is a statistician who was at UW-Madison.
Oh, I had no idea. Maybe it's just in the water over here.
Yes, it might be.
Yeah.
Any other questions? Great. Well, again, thank you again. And
My pleasure.